Welcome back. You're watching us here on Chartbusters. We have with us the management of Indegene reported a muted set of second quarter numbers where revenue growth remains soft and margins as well contracted, as a result of which the stock now down 6% as we speak. Suhas Prabhu, the CFO of the company, joins us to review the quarter gone by. Thanks a lot, Mr. Prabhu, for joining in. You know, when you came to the street with an IPO, your 3-year CAGR, at least in the enterprise business, was close to around 55%, the enterprise commercial solutions. This quarter and the last couple of quarters, they've been soft. FY24, your revenue growth was just around 12%. Now as well, you know, year-on-year revenue growth has just been around 8%. So wanted to understand what exactly is causing this softness in revenue, and what's the target for this year as far as top line and margins are concerned?
Thanks. Firstly, good morning, and thanks for having me on your channel once again. Coming to the current quarter performance and more specifically the enterprise business. Actually, the enterprise commercial and enterprise medical business at Indegene, which is about 85% of our overall revenue, has grown sequentially at 3.6% from quarter one to quarter two. While the overall revenue growth was 1.5%, the strong growth in the enterprise business has been partially offset by a bit of a decline in the other two segments, which is the consulting part of the other segment and the omni-channel activation. Given at the current scale, these two segments have a little higher proportion of project businesses, which some of which have come to a close, and the offtake of the new projects have not fully offset the conclusion of the projects that came to a close. But I would like to highlight again that the enterprise commercial and enterprise medical businesses, which together are 85%, continue to see a strong growth, 3.6% quarter on quarter. More specifically, enterprise medical was north of 4%, while enterprise commercial was 3% growth. We believe that this bodes well for the future. The proportion of revenues from the larger customers higher in these segments, and are also more recurring kind of businesses.
Good morning, Suhas. Happy Dhanteras to you as well as your entire team. You've given us some color on the business, but let's get two basic numbers out of the way. First half of the year, you've grown by 10%, right? Your margins as well have improved to around 18, close to around 19%. For the year, should we expect double-digit growth? If yes, could you quantify it? And what is the margin outlook? Do you see that number head to around 20%? Let's get these two numbers out of the way.
Yes. So while we are not giving any forecast and forward-looking guidance, the way things are panning out from a growth perspective as well, right? We believe that H2 should be stronger than H1 coming out of Q1. In the quarter one earnings, we had mentioned that a couple of our customers, we were seeing certain headwinds coming out of their internal issues, restructuring and the like. As we speak today, we believe the revenues from these two customers, which are part of our top 5, have stabilized. In the current quarter, actually, our top 5 customers have grown by 2.5% or thereabouts quarter on quarter. And second thing is that the new logos that we added have started yielding revenues. As you can see, our number of active customers have grown from 63 to 68 over the last 2 quarters. The number of $1 million customers have grown to 37 in this quarter. So overall, I would say we are seeing stabilizing and growing revenues with our top 5 customers, while we continue to add new customers as we grow into the future. And I would say this is assuring for us heading into H2.
All right, 2-part question for that itself. One is that if you could give us a sense of how many customers did you add in the previous quarter? What are you likely to add over the next few quarters on a quarterly run rate, and in what buckets are you looking at adding these customers? 1 million, then there are 10 to 20 million plus thereafter as well. And secondly, your acquisition Trilogy that you acquired in 2024, Obviously, that is playing out as well. So how's the growth and scale up of that business along with the operational efficiency there?
Yes. So firstly, let me address the customer segment. As you rightly pointed out, we're looking at growing the $1 million customers, which have been steadily growing, continuing that pace. Many of our active customers, the 68 customers that we have over the next few quarters, should become $1 million plus customers for us. And this number of 37 going into the 40s and heading towards 50 over the next couple of years. While we do that, having more $1 million customers, we see some of the $1 million customers moving into the 10 million plus and so on. One of the key things that I would also like to highlight is our largest customer, which was $42 million in annual revenues in the last fiscal year, has continued to grow. And we believe in the coming 2-3 cycles, we should see this customer breaching the 50 million mark. And therefore, we continue to grow across the spectrum, adding more customers, as well as growing our existing customers into the next range of revenues. The second question on Trilogy, while Trilogy has been integrated into our enterprise medical business, and the joint go-to-market has already started playing out, some of the benefits that you can see would reflect in the higher growth rate in our enterprise medical business. Having said that, the regulatory and clinical writing part of our enterprise medical business is where Trilogy has been integrated into. And today we have better credentials, better access for larger global deals, covering especially key markets in Europe, which is where Trilogy has a strong presence, complementing our existing presence in North America, combined with offshoring ability coming out of India, as well as nearshoring ability in multiple markets that we have already established.
Perfect. All right, Suhas, a little short on time, but we appreciate you joining in and detailing those numbers and the path ahead as well for the company. Thanks a lot for joining in.
Thanks again for having me.
Quick check on the markets, by the way. When we were